So you're paying $5 for it. It depreciates the next day, even though you're correct. The stock is going higher, but the value of your option is going lower. The reason that happens is because it had an average move. In other words, an average move after earnings of 5%. Now, the only time you win is the company when you're right about the direction and when the company has an extraordinary move. An extraordinary move would be 15 or 20%. So in this case, if it goes down, if it goes by 15% higher, which would be roughly $15, and the stock opens up Monday at $110, then your option is definitely going to be worth $10 because you're at least going to be in the money by $10. So it could be worth as much as 11 or 12 because you're still going to have 4 more days left. Okay?
Yeah, but if you look at Priceline, I mean, Priceline shot up $100, $125 after the earnings. So why we did not buy? Why you didn't buy the call on that one?
Okay, okay. Well, listen. Remember that it would have costed you roughly $60 to even buy that kind of call. Okay.
Oh, okay. Okay, gotcha.
Right. So let's say if Priceline didn't go by $150, what if it just went up by 100? Well, your option might have been worth only 50 by that point. Let's say you were to buy 1950 calls, right? So the point I'm trying to illustrate here, number one, you have to be correct about the price move, okay? And guess what? Your possibility of being correct is only 33%. It's not 50%. Do you know why it's only 33%?
Yeah, because it can go down or it can go sideways. So that
right.
To 3.
If it stays, if the earnings are no here, no there, if it goes down, let's say in this case, Herbalife goes down to 97 and then it goes down to 92 and the next day it opens up at 95, your option is worth, your $100 call is worth maybe 50 cents now. Okay? So you lose. If it goes down, you lose. And you only win if it goes up, and it has to go by a lot in order for you to make the money. So in other words, in the case of Priceline, your calls you would have been buying them for $60. Even if the stock goes up $150, well, the best case scenario you may get is now your option is going to be worth $120, which is what? That's only doubling your money. Okay? But right. So that's not a good risk reward. See, what you want to have is a situation where, you're putting $60, buying the option, and you're selling it for, at least, 200, 300. At least you're making, 300-400% return. I mean, those are the kind of situations we want to look into, okay? But if you're just doubling your money, and look, it's 33% possibility if you are right on the direction. But what are the chances that the stock is going to go more than 5%? The chances of that are totally unpredictable. So if you're buying a call during earnings, okay, the real possibility of you making money is only maybe about 5-10%. You're going to be more often wrong than right. Does that make sense?
Got it. Yeah.
So you're always putting yourself in a loose situation. Your possibility is very small, mainly because not only you have to be right about the direction, but you also have to be certain that the move is going to be extraordinarily higher than a typical move that the stock has made during earnings announcements in the past. Okay? So just being right about the direction is not good enough. That's not going to make you money. Okay.
Yeah, but how about... what I see is that before earnings, the price go up, right?
The price of the option. The price of the option is going to go up on both ends, on calls and puts, because they don't know which direction it's going to go.
How about price of the stock?
Well, no, it could go lower. As a matter of fact, there is more statistical data that shows those stocks that the day of the earnings report is supposed to be announced after hours. If those stocks are selling off that day, in other words, if they're going down, that there is a high chance that the next day they're going to go up. Okay, those stocks that are going higher the day of the earnings report, there is a greater possibility of them actually going lower after they announce the earnings. So that, I know, the statistical data is there to confirm that. Again, it's not a 70 to 30% ratio. It's like 55 to 45. So it's almost like, there's a little higher chance if it goes down, then it's going to go up the next day. But, it's not much greater the chance. So your possibilities and probabilities, they don't work out in your favor. That's why you don't want to buy options before earnings. Sure, you can get lucky here and there a couple of times in a year, but 90% of the time or 95% of the time, you're not going to time it. You're not going to time it perfectly. You're not going to, and the return, if you are going to time it, your returns are not going to be huge. You're not going to get a 700-800% return. Yes, there is a small chance of that, but more often than not, it's not going to work. So what you want to do is you want to buy. Let's say a Herbalife opens at maybe 92.50. So now, the night before we were thinking, well, it's going to announce good earnings. It has a lot of bullish patterns, but for whatever reason, in the morning, it's just not going higher. Well, what if it's just about to reverse its pattern? What if maybe somebody is just selling some stock and some new buyers are about to come in? But when it's at 92.50, how much of these $100 calls are worth? Maybe 10 cents, 20 cents. So I'm going to buy it there. If I really think there is a capacity for the stock to reverse and go higher after the earnings, if I'm seeing like they're trying to bring it to 92.50 and just not going lower below that, then I may take that as an opportunity to buy some calls at that point. I'm going to buy them super cheap, and then I can have a 6, 7, 800% return. Okay. Now the same thing is with the puts. If I buy the 90 put right now, it's going to cost me $5. Right? If I buy the same thing with the puts, if I buy the $90 put, it's going to cost me $5. Well, what if the stock goes up to $99 in the morning? How much of these $90 puts are worth? 10, 20 cents. If I think the stock is going to go higher and reverse, because people are going to use this possibility to sell it.
If you have been curious how to make the money when markets fall, please visit marketcrash.money and get some additional information. Specifically, I have compiled some interesting reasons why stock market crash 2010 is a definite possibility, why we could be going for another Bitcoin crash, and more importantly, how to not let the market crash or the Bitcoin crash take advantage of you. Find out how to profit. If you're a new trader or an experienced trader, but you're looking for new ideas, new ways, how to take advantage of the market fall, because quite honestly, markets do fall much, much faster than they go up. So it represents, for a trader, a great opportunity to profit on the opposite direction of the market in a much shorter time frame, and oftentimes maximize much bigger returns. So if interested in knowing the ways how I trade weekly options for huge profits as much as 3,800% to 5,000% on certain days, get in touch with me. Visit this link right here, how to profit, read some information, and schedule your consultation. I'll be glad to help out and get somebody on the right track and show you some of my profitable ideas and share some experience which I've accumulated over the last 30 years trading weekly options. Thanks for watching. I hope this was helpful. We'll see you soon.